Paul Rosenblum is a bookkeeper, not an accountant or a CPA. Although the information in this podcast comes from professionals, it's meant to give you enough knowledge about these subjects to have a meaningful dialogue with your tax preparer about bookkeeping and taxing.
One of the most popular episodes in this podcast that started in May of 2022 is episode 7, The Chart of Accounts. So after 2 years and graduating from a podcast novice to a sophomore, or is it now a junior podcaster, this episode is ready for a redo. I will go into more detail about the balance sheet accounts and the income statement, better known as the profit and loss, in another 2-part episode. Welcome to the first episode of year 3 of this podcast. I'm still recovering from tax season. Paul Rosenblum. The COA, or Chart of Accounts, is how one tells the financial story of their business. It's so important to have a story that investors, banks, and anyone else looking at your books can follow and understand about how your business is operating financially. I can't fit everything in this 2-part episode, so subscribe to the newsletter for more information about the Chart of Accounts, among other accounting tips and tricks. Sign up at paulrosenblum.substack.com. The Chart of Accounts is typically made up of 5 categories, sometimes 6, depending on the kind of business that you have. These are assets, liability, equity, income, expenses, and the 6th category, if you need it, would be cost of goods. This is a typical category if you are selling goods or products, or if you're in the restaurant or hospitality field. It can also be used for subcontracted labor or outside services. In other words, a cost of goods account, as I've mentioned in other episodes, have to do with a kind of an expense that is directly related to your revenue or your income accounts. However, today we are focusing in on only the balance sheet accounts, which are assets, liabilities, and equity. The assets have specific categories. The main ones are current assets, fixed assets, other assets, and accounts receivable. Shareholder loans for corporations and sometimes partnerships can be booked as a current asset or an other asset, depending on how long it's going to take for a shareholder of the company to pay that loan back. Current assets are made up of bank accounts, petty cash, cash in a cash register at the start of the day, and any cash either in a safe waiting to be deposited into the bank or being used as petty cash for deductible business expenses. Most accounting or bookkeeping software will have these categories split up into bank accounts and the rest of the current assets named appropriately, such as petty cash, cash on hand, or even miscellaneous cash, if needed. If you have a POS system for your retail store, or a restaurant or a bar or a food truck business, then you'd need a cash on hand account that would be adjusted every month to match the POS or point of sale system for sales purposes. The cash on hand account is an account used for cash and credit card sales deposited into the bank so that the bank account can then be reconciled. At the end of the month, the bookkeeper will adjust the value from the cash on hand account to the revenue or sales accounts to match the POS system. Fixed assets are made up of large equipment, office equipment, furniture, computers, cell phones, and leasehold improvements to a building that you either own or rent if your company is paying for those improvements, such as plumbing, storefront improvements, electrical, or drywalls to separate rooms. Other assets are made up of security deposits that you pay out, security for your office rent or utilities for 2 examples. Any money that you pay out that you will eventually get back are considered other assets. They also include loans that your company makes to other people, companies, or even employees. If you make a very short-term loan to a person, company, or employee, you could put them under current assets. However, there are exceptions in some of these categories. Let's say you own a restaurant or a bar and you purchase a 2-year liquor license from the state. How would that be booked into your accounting system? I'd book the payment for the 2-year license as an asset. I'd enter it as a fixed asset because the definition of a fixed asset is any asset that you purchase that has a life expectancy of more than 1 year. If entered as a fixed asset, the bookkeeper or the tax preparer can make an entry diminishing that fixed asset by half and increasing the expenses by the same amount at the end of the tax or calendar year. So what will be left going into the next year is only the value of the second year of the asset, which won't be used up until the end of the next year. If the liquor license was purchased in March of 2024, then at the end of the year, 9 months of that year would be subtracted from the asset and moved into the expenses via an adjusting entry that the tax preparer or bookkeeper can do through an expense account called amortization expenses. If you enter something that is a fixed asset, but enter it as a current asset or an other asset, it won't affect the numbers on the balance sheet. Many tax preparers won't even notice as long as they are in as an asset that shows up on the balance sheet and not the profit and loss reports. Sole proprietorships and single-member LLCs don't have to report a balance sheet on their taxes, so many tax preparers won't even look at the balance sheet, but they should. However, in computerized software, the category can be changed at any time if ever needed. Accounts receivable, an asset because it's connected to customer invoices that you create in your bookkeeping system. When you create a customer invoice, the amount of the invoice is automatically posted to accounts receivable by the software. This includes sales tax, since the customer or client will pay the full amount of the invoice. Once you collect the unpaid accounts receivable invoice, the accounts receivable value goes down and either the bank account cash asset increases or the petty cash or the cash on hand increases, depending on how you collect money and if that money goes into your bank account or not. Liabilities are made up of 2 kinds of accounts, current and long-term. Current liabilities. This account is made up of money owed by your company in the form of loans due within a year, credit cards, credit lines, accounts payable, the opposite of accounts receivable, vehicle or machine financing but not leasing, sales tax payable, and some payroll taxes. Liabilities for your business do not include taxes that you pay as an individual, so props and partnerships and corporations are pass-through companies. That is, the profit of the company flows through to your personal taxes. You can pay your taxes with company money, but we'll talk about that a little later on, where to book those payments. Actual company taxes are not considered liabilities of your company, except for payroll taxes that are paid quarterly. Most corporations and partnerships have to report the balance sheet to the IRS in the taxes, so it's important that the balance sheet is correct. Equity accounts represent basically 3 things. Number 1, the amount of money invested in the company by the owners or partners or outside investors. In a partnership or a corporation, this is tracked and reported to the IRS in taxes via a K-1 form. 2. Distributions taken out by the owner or partners back to themselves. This is a separate equity account, so one can see the total money invested and the total money taken out by an owner or an outside investor. In a sole proprietorship, the word draw is used. In a partnership or a corporation, the word distribution is used. Listen to episode 28 on partnerships where I go deeper into that issue. Included in a draw or a distribution is when the company pays for an expense such as dry cleaning, which isn't tax deductible for the company most or close to all of the time. Number 3, retained earnings. That is a cumulative value of the overall profit or loss that a company has made in its entire history. For example, if the first year a company is in business, there's a loss of $50,000, and the second year there's a profit of $50,000, then the retained earnings equity account will be at 0. This account should not be touched by bookkeepers since it's an automatic cumulative account controlled by the software used and by the data entered. The balance sheet is a cumulative value based on the historical transactions that a company has had from the very beginning of its creation, unlike the profit and loss, which we will discuss in the next episode. You can, however, run detailed balance sheet reports for a particular time period as you wish. There are always adjustments made on the balance sheet at the end of the year, usually by the tax preparer. As I have mentioned in other episodes throughout the series, distributions taken out by the owner of the business could be booked as a shareholder's loan, which would not be taxable on the K-1 tax form. Some business owners do a December payroll for themselves that is 100% payroll tax. The owner doesn't see a check. The entire payroll done for the owner is 100% payroll taxable, and the taxes withheld are entered on the balance sheet. The company's share of the taxes are on the profit and loss. This way, the owner can get a refund on their payroll and lower the profit of the company at the same time. We've talked about this in other episodes, but worth saying again here. The books put together by the bookkeeper are not going to be what's on your tax return because of all of the adjustments that will be made by the tax preparer. And you thought bookkeeping was easy? This is why I sometimes rant about Intuit, the makers of QuickBooks Online. Their marketing strategy has always been to tell people how easy this is when it really is not. But I will not digress anymore. And where do trademarks and logos get booked into the chart of accounts? They are also balance sheet accounts counted as assets. They get amortized rather than depreciated because they aren't a product that you can touch like a piece of furniture. They are ideas or writings, or another one, website design, not just changing a picture or some text on the website, but actually designing the website. They would be fixed assets because the life expectancy of a website is more than 1 year. Another exception to the rule. How about if a customer pays you for 1 year of services in advance that you haven't even performed yet? In accounting, we would call that a current liability, even though that money went into your bank account, because if the services were never performed by you or your company, then you'd have to refund that money back to the customer. However, most computerized software allow you to enter negative accounts receivable. That is, the payment coming in from the customer will be booked to accounts receivable without a customer invoice being created. In that case, it would show a negative amount on the customer's ledger. In accounting, there is no such thing as negative accounts receivable. It's either counted as taxable income or a liability, in this case, at the end of the year. So lots of exceptions to the rules. It's not just money in, money out. It's a giant jigsaw puzzle with thousands of pieces to put together. This is why it takes a team to really do bookkeeping and taxes completely and accurately. The chart of accounts is the backbone of your accounting for the entire company. This is how you paint a picture of how your company is doing. The names of the accounts and what section those accounts are in are very important in creating accurate books. In most software for accounting and bookkeeping, you can even create a second or a third accounts receivable account to track specific receivables, either by creating a sub-account of the built-in accounts receivable or a regular current liability just called accounts receivable, although the function of that account in the software will act differently. Any specific questions about this? Please drop me a line at bookkeepermensch@gmail.com. And when this episode is online, there will be an accompanying newsletter at Substack with some tips and tricks about the chart of accounts in terms of debits and credits. I know, that double entry jargon.